Hello, my retro friends. Thanks for finding my channel, Mike the Retro Realtor.
I don't like you because you're dangerous. That's right. I am dangerous.
Today, we're going to talk about the 50-year mortgage. And I know it's been in the news lately. I know I'm a little late to the game for getting this video out, but it's the holidays and I got to make my Christmas videos, and I like that fun. So I got a couple takes on the 50-year mortgage. I am a fan of the 30-year mortgage, and if you can do it, the 15-year mortgage is even better.
Okay.
Do it. Do it.
But I'm actually going to point out to a couple reasons why you should avoid the 50-year mortgage and why it actually might make sense. It might be a good thing.
From a certain point of view.
I would say 90% of my transactions involve a 30-year mortgage. When I purchase a home or an investment property, I do the 30-year mortgage. One thing about a mortgage, which I really like, it's kind of a one-way contract. Now hear me out, in nearly every case of a mortgage, you have several options. One of them is super easy, one of them is kind of expensive, maybe not worth doing. But these are options that you have. Now, as long as you make your normal payment on a 30-year mortgage, the bank's happy, they'll leave you alone. In nearly every case, you can pay additional principal. That's the simplest way to pay down your mortgage. I'm a huge fan of that. Every single one of my mortgages, I round up to the nearest $100 bill. And the highest mortgage in terms of percentage, I actually really attack that one because that's a rental property and that's a sub $100,000 mortgage. So I try to pay down an extra $1,000 every month just to knock that thing out, because that's where I'm paying the most interest. We're in this weird world right now where most of us have, for their homes, 3.5% interest rates, which is fantastic, or sometimes even lower. So you're much less motivated to pay those off first. You know, you pay off your car loan, you pay off your credit cards, which I don't really have those. Now all my extra money goes to my mortgages. That's the easiest way to kind of work around a 30-year mortgage. And of course, all that money goes on the back end, and your 30-year note going down every payment you make when you make those additional payments. The other way to do it, and I'm not nearly as big of a fan right now because most of my mortgages are 3.5%, 4.5% interest rates. The banks can't touch that right now. You can do a refinance, and that's also very expensive. You got to pay all the bank fees plus an appraisal. I'm not a big fan of those right now because it just doesn't make sense. But that is something you can definitely do. So a refinance basically, in essence, pays off the old mortgage. The original bank is made whole. Now you're working with a new bank. It might be the same bank, but it's a new note. So the 50-year note, all the same logic applies. I'm not a fan of the 50-year note, but there are circumstances where you might want to get one. In fact, I actually have a 50-year note on my home in Brookfield. What happened was during the meltdown, my properties were so far underwater, the banks were scrambling to keep me paying the payments. They did not want to foreclose. So I'm sitting in my house one day and a UPS package shows up, and without even asking for it, there's a loan modification. A loan modification is actually from the bank deciding, hey, we're going to do a refinance for you. And in most cases, it costs zero money and you're far better off. So this is what happened to me. I bought my house in Brookfield back in April of 2007. Around 2010, 2011, we had the meltdown. I was paying 6.9% interest on the balance of a $350,000 mortgage. So they came along and offered me on a 50-year note, 3.5% interest on the balance, which was about $350,000. I really didn't pay down much in those couple of years. So we'll say a $350,000 note. The only rub, if you want to call it that, is I was only 2 years into my 30-year mortgage. Now I'm starting fresh on a 50-year mortgage. And of course, I couldn't jump on it fast enough. My $2,700 payment went down to $1,800. So now I started out a brand new 50-year mortgage about 15 years ago. So I'm only 15 years into it. But as things got better, I started really attacking that mortgage. I probably paid off an additional 20 years worth of that mortgage. So now let's say I owe about $200, $250. I really don't look that much. The payment's $1,800. I pay it every month and don't think twice about it. You can argue like, oh, if you die tomorrow, your kids are going to inherit this mortgage of $200,000 or $250,000. So yes, my kids might inherit a $250,000 mortgage. They're also inheriting a house that appreciated, had some artificial appreciation through inflation, and of course principal reduction through additional payments. So now, let's say the house is worth $750,000, which is about right for a 3,000 square foot house in Brookfield. The kids are way ahead if I was to go tomorrow. Paying off that mortgage is now on the bottom of the priority list in terms of additional principal. Yes, I still round up to the nearest $100, which I could do everything else, but I don't really care when I pay that thing off now. The properties I'm buying in the city at 8.5% because it's a non-owner occupied property, and those were interest rates as of 2 years ago. Those are the ones I'm paying off way faster because those are becoming my cash cows. With my own personal experience with the 50-year mortgage, it's working out very well for myself. If you're a first-time buyer, would I recommend getting a 50-year mortgage? Absolutely not. So let's do some numbers. I'm not the biggest fan of numbers because I don't want you walking into a mortgage broker and saying, hey, Mike the Retro Realtor says this, and we all know that he's right on everything. So if you were to take a 30-year mortgage on a $400,000 house, and you put down 20% at 6.25% interest rate, your monthly payment, principal and interest alone, will be about $1,975. And your principal and interest payments over the course of that 30 years will be about $710,000. That's assuming you don't do any type of refinance. That's assuming you pay every payment to the penny on the first of the month and never pay additional principal. Now, let's look at the 50-year mortgage. For the same $400,000 mortgage with 20% down and 6.25% interest, your monthly payment will be $1,750. So you're going to save about $225 a month. That's negligible at best. Over the course of 50 years, again, assuming you don't do any type of refines or pay any principal in advance, you'll be paying $1,047,000.
$1 million!
A difference of nearly $335,000. So yes, in this example, you are saving $225 a month. You'll pay over $300,000 to buy those extra 20 years. But if you're looking for lots of flexibility and this is your forever house, yeah, I guess you could make the argument for the 50-year note, as long as you understand you're going to pay off as much as you can, as quickly as you can. And if you're in your high earner years, as you move into this new house, that actually might make sense for that flexibility. I would still always recommend the 30. If you do have a goal of paying off your house, the 15. If it's difference between not getting a house and renting for the rest of your life and taking on a 50-year mortgage, I guess I would take the 50-year mortgage, pay it off as fast as I can.
You take the red pill, you stay in Wonderland, and I show you how deep the rabbit hole goes.
Even at my age, a 50-year mortgage, I probably won't live to see the end of it if I don't pay it off. I don't really care. So I guess what I'm saying is, it's definitely not for everyone. I don't think the 50-year mortgage deserves the hate it's getting. If you understand the rules, you'll do fine with it. Do I recommend it? No. But sometimes it makes sense for an individual. That being said, keep it retro, my friends. We'll talk to you later.